Okay, good evening. Please, can you hear me?
Yes, sir, we can hear you.
Okay, good evening. I hope we are all doing fine. I hope you are all fine, right?
Yeah, yeah, we are good by the grace of God.
As you guys already know, my name is Rako. And in today's session, please, can you guys see my screen?
Yeah, you can see your screen.
And in today's,
Happy.
we are going to talk about fair value gaps, right? Fair value gaps also play a vital role in our trading. So if you're able to understand it and understand it very well, it's really going to change our trading game. So what is fair value gap? Fair value gap is basically an unhealthy price action that either moves price to the upside or downside. Oh, so fair value gap is basically a movement of price to the upside or downside without any mitigation. So basically, this market is based on buying and selling. So definitely, if there's a sell movement, there should be some buys so that the sales can continue. So wotɔn adeɛ na sɛ mambɛtɔ a, ntumi nkɔ so antɔn, right? You might be like discouraged to sell. So basically, this is how the market is also. So if a market is, let's say, selling or buying, right? There need to be some sort, like some form of mitigation. But if there is no mitigation, the difference or the space between it is what we call the fair value gap. So basically, fair value gaps entail a first candle and then a third candle, right? So if you have three candles, like 1, 2, 3, the first and then the third, the gap between them is what we call the fair value gap. So basically, in this candle, this will be the fair value gap. So basically, in this candle, in these three moves, this will be the fair value gap. From here to here, the space between it is the fair value gap, right? This is a buying move. This is a buying move. So this will be the first, this will be the fair value gap. So when we are also looking at the sell and selling move, right? This is the selling move, the first and then the last candle. The difference between them is what we call the fair value gap. So the difference between them is this one, right? Right. This is the fair value gap. But if in case, so this is what we call the fair value gap, and basically. But if in case price, if in case market pulls up like this, and then comes to mitigate here, right? Then there is no fair value gap because price has been able to come back to mitigate. So there is no fair value gap. You understand? Or if in case it's like this, and like this. Right? There's no fair value gap. So we don't have to be waiting for price to come and fill there before going. So definitely what we know about this market is whenever there are fair value gaps, if not today, definitely market will need to come and then fill it before moving to the direction that it wants to. So this will this fair value gap topic will let me dive in deep into structure mapping, like mapping structures, bars, chalks, and then stuff, because we need them. We need the bars and then chalks so much. I remember I first spoke about it, but I'm not sure I went into that deep. So today I'll go into that deep for us to know how to map our structures very, very, very well. So basically, this is the fair value gap, the difference, or let's say the space between the first candlestick and then the third candlestick. Or if there is another one there, so this, if let's say there's another candlestick like this. If let's say there's another candlestick like this. If there's also another candlestick, so here right now, this first and then this third one, a space between here and here becomes our fair value gap. Becomes our fair value gap. So basically, this is it. But there can be some situations that fair value gaps might be confusing. So let me dive in deep. I hope we understand up to this point, right? If you understand up to this point, you can just type, yes, I understand for me, just in the chat box. Yes, I understand, then I can move on from here. All right. So okay, so basically, I'm like fair value gaps is an unhealthy price action which causes price to move very fast, either to the upside or downside. So either price is moving up or is moving down, but in a fast way, like in a speed way, which is not making the candlestick be mitigated before moving to the directions. So I was like, it's basically the difference or the gap between the first candlestick and then the third candlestick, basically. So if let's say this candle is here, right, and then this was where it started, and this was where it's opened and then came up here before coming down. And this is the third one. Okay, sorry. This is where it opened, came up here, came up all the way to here before came to close here, before this one opened. So the gap between this one and then this one and then this one becomes our fair value gap. So that's where I have drawn this box. So the gap between them is the fair value gap. The gap between here and here is the fair value gap. So same thing as here also, the gap between here and here is the fair value gap, right? But if in case there was a mitigation, for example, this wick was able to cross. So for example, if this wick was able to stretch up to here, right? Then there is no gap. So we cannot assume that here becomes a fair value gap. But here that there is nothing mitigated here, then we can assume here is a fair value gap. Do you understand it now?
Yeah.
Okay. So let's move on. So I was like, there can be a situation where these fair value gaps can be confusing to understand. See, the market makers don't really want us to always win the market. So they can make the fair value gap look confusing in the sense that, see, look at this. Let me throw up this question. Maybe those who join the other class will be able to get this correct. So let's say having some buying. And let's do very with DD. One me, but I'm going to I hope you find. Oh, well, then like to me and then all right. Okay, so the question I want to post to you guys is if you know the answer, just write it in the comment section. Some people don't want to talk, so if you don't want to talk, just write it in the comment section. Right. Is there any fair value gap in this movement? Is there any fair value gap in this movement? Okay. Another one is saying no. Okay, two people are saying no. No. Okay, so if you can annotate on your screen, like you see when you click, when you're using Zoom, there's some parts you can use annotation, even as you joining, right? Kindly annotate on the screen for me. Or okay, no. Explain to me why there's no, kindly explain to me why there's no fair value gap in this movement. Just you can type. If you can also, okay, so okay. Abeg, you feel annotate give me where price has mitigated. If you can write on the screen, or if you don't know how to do it, okay, and then where price mitigated, then so really, but I thought this place will be a fair value gap. I thought this place, a gap between here and here, will be a fair value gap. I thought the gap between here and here, this place, and then this place. I thought it will be a fair value gap, or it's not. Or it's not. And so explain it for me. Your annotation, no, I don't understand it. So I mean, you see this move, right? And this move, it has not been mitigated. So I'm asking if this gap here, why are you saying it is not a fair value gap?
I think it's not a fair value gap because
Okay.
on the previous buy move, you were teaching. You told us that looking at the first and the third one,
Yeah.
you can see there was a wick on the third candlestick.
You mean this one?
On the buy move,
You mean this one?
which one?
You mean
I
this
can't.
this candle? Okay.
No, the one you were using as an example, the buy move.
Okay, so this buy move, right?
Yes,
This buy move. Okay, so
yes,
there was a wick.
yes, yeah,
So it means there is no mitigation.
yes, please.
Your explanation, no. Your explanation, no. The answer is correct, but the explanation, no, that's the problem. So let me quickly explain this. Then let me quickly explain this. So there is no why there is no fair value gap is because this, where is it? This candle, I think, so this candle and this is the last buying move because this was the candle that was having the lowest, right? And then having the highest in this. So meaning that this was between it. So there's no kind of pullback. If you remember the pullback we spoke about, there's no kind of pullback in here for us to identify this as a fair value gap. So you can see from here that price came to mitigate it here, right? So this is the lowest and then the highest in this move, and price has come to mitigate it. So here is not qualified as a pullback. But if anchor here was the lowest, here came down to become the lowest. But if like here came down to become the lowest, right? Then anchor, there will be a fair value gap between here and here. So this place and then this place will be the fair value gap, right? Since this one was the very, very longest tail, like if this one was the longest tail or the longest buying move, right? Or let's say it was having the highest distance, right? That's when we will accept here to become a fair value gap. But since here, in this case, here was rather the longest tail and the highest in here. So the longest tail's high will, has been already mitigated. So there won't be any form of fair value gap here. Do we understand? Wow. I'm shouting. Oh, I'm really, really shouting. So I was like, there is no fair value gap because this is the longest tail in this move, right? This is the longest tail. So the highest of that longest tail will determine whether there will be a fair value gap or no fair value gap. So looking at the highest here, right, it has been mitigated. But if this was rather the longest tail, right, we would have used this high and then see some sort of fair value gap. But since this one was rather the longest tail, then it has been mitigated already. Do you understand up to this point? Okay. Okay, so let's move on. Okay, so let's try and then identify this kind of stuff in the chat. So, okay, one thing we have to know is, you see, markets normally moves in waves, as we know already, right? So if let's say market is going like this, let's say in a buy form, I think if in case market is going like this, like this, like this, like this to take inducement, right? Since there is a break of structure here, since there is a break of structure here, right? Since there is a break of structure here, here becomes our inducement, as we know already. Inducement or SMT, any of them. Right? Markets will only come and then retest on the fair value gaps between here. You see, markets will come and then retest on the fair value gaps between here. Like if in case it's reversing back, right? It will come and then look for the fair value gaps between where the move, like where the inducement was taken before the break of structure. So markets will come and then look for the fair value gaps there. But if in case there's a fair value gap here, right? If in case there's a fair value gap here, around below here, markets will only come here to come and then fill the fair value gap only when there has been a change of character, like choke, right? So if in case markets continue to move to the upside like this, okay, so it came from something like this, came here, came to take this inducement, right? Here becomes our lower low. Market came to take the lower low, and then come down again, take inducement. Take inducement, tap on the POI. That's when it will be coming to this fair value gap below here. That's when it will be coming to this fair value gap below here. So as this is what I mean. So this will be what? A break of structure, right? Break of structure. Our last pullback before the break of structure is here. Becomes our inducement, right? Market takes out the inducement and then push higher again to become break of structure again. Then market now, this becomes our lower low. Market now takes our lower low. Higher low, sorry. market takes a higher low to become what? Change of character. Then markets continue to break down to become a bust, right? Break of structure here. Break of structure here. Here becomes our inducement, the last pullback before this break of structure. So our inducement, and then here becomes our PY. So that will be when market will be coming for this below fair value gap. But if market just broke and then formed some fair value gap below here after the break of structure, then market will come and then fill it before going, right? So it can be can fill it before going. So here, for example, after the change of character, there might be some fair value gaps here. That will be what market will come and then what? Fill. That will be what market will come and then fill before going down. You understand? So I hope we understand this. I hope you understand this, that markets after breaking structure will not come and then fill straight away, fill the lowest form of this thing below the lower low, right? If there is anything like that, then it becomes change of character. But after breaking structure, market can come and then fill the fair value gaps just between the movement that broke the structure and then move, continue the move. That's why sometimes you can see some fair value gaps unmitigated and then still they are there. You understand? Market will not come there after it has already breaking structure or something. Do we understand up to this point? Abeg, do you understand up to this point?
Yes, yes.
Okay. Okay. So now let's look at something here. So for example, in this move to the outside here, right? This will be our lowest candle here. And then the third one is here. And here will be something like a break of structure, right? Break of structure is here. We are talking about fair value gaps. We're talking about fair value gaps. So that's it here. Here becomes something like a break of structure. Here becomes something like a break of structure, right? So after the break of structure, you can see from here. You can see from here that there is some fair value gap here, right? There's some fair value gap here. There's some fair value gap here. You understand? But market will not come and then, you see, this was the fair value gap here. And it only came to mitigate that fair value gap. It won't come down here to come and then mitigate this fair value gap. After break of structure, it will just mitigate the fair value gap it's left there. You understand? before this move, and then it will just fill. Sometimes it will fill some, sometimes it will fill all before moving. So if it fills all, it will come and then tap on your POI and then move. You get a move. So for example, it broke structure here again, right? Broke structure here again. Broke structure here again. And then left a form of fair value gap here. You can see. Let's see. Right. Right. What can we see? Market came to what? Fill the fair value gap, and then boom, continued upwards. Do we understand? Do we understand?
Yes.
Okay.
Yes.
So
Go on.
definitely after this topic, I'm sure plenty people will be able to take risks, because now you know market structure, you know the trend, you know where to take entries, you know where to. So normally, let me touch on this before the time runs out. So normally these fair value gaps are used for either entries or take profit, or take profit, for example. So if let's say you are looking for entries, let's say market has broken structure, right? You are looking for entries for buys, right? Your main target should be between like the fair value. If let's say there's an order block and there's a fair value gap on top, fine, then your target should be on the order block. But if in case there's no order block and there's some fair value gaps, then you can also take trade on the fair value gap, right? And if in case you know that after break of structure, there should be some form of retest before movement. So you want to sell. So you start selling from the top, and then your take profit will be between the fair value gap, any of them. Then once you meet your target, you also enter in a buy again. You understand? You understand?
Yeah.
Okay, so